You bought your first stock 6 months ago. It's up 40%. You're thinking about selling to lock in the profit. But here's what nobody told you when you clicked buy. The difference between selling today versus waiting 6 more months could cost you hundreds or even thousands in taxes. What you know about stock taxes isn't wrong, it's just catastrophically incomplete. Hey, it's Ollie, and today I'm going to make stock taxes genuinely click for you. I've spent years watching investors make the same expensive timing mistake over and over. Let me paint you a picture. Sarah bought 100 shares of a growth stock at $50 each. 6 months later, it hit $70, a sweet $2,000 profit. She sells, thinking she's nailed it. But here's the kicker. If she'd waited just 6 more months to sell those exact same shares at that exact same price, she would have kept an extra $340 in her pocket instead of handing it to the IRS. The difference? 2 completely different tax systems that kick in based on one simple timeline. But that timeline difference is just the beginning of what most investors miss. Here's where it gets fascinating, and this is pure government policy genius or madness, depending on your perspective. Hold a stock for 365 days or less, and your profits get hammered with short-term capital gains tax, which is taxed exactly like your regular paycheck. We're talking rates up to 37% for high earners. But hold that same stock for 366 days or more, and boom, you've unlocked long-term capital gains treatment, with rates maxing out at just 20% for most people. Think about that. One single day can cut your tax rate nearly in half. Let's go back to Sarah's story and see what this actually means in cold, hard numbers. That's where the real eye-opener lives. Sarah made that $2,000 profit in 6 months, so it's short-term capital gains. Let's say she's in the 22% tax bracket, pretty typical for a working professional. Her short-term gain gets taxed at 22%, so she owes $440 in taxes, keeping $1,560 of her profit. Now here's the parallel universe version. If she'd held for over a year, that same $2,000 profit would be long-term capital gains. At her income level, she'd likely pay just 15%, that's only $300 in taxes, keeping $1,700. Same stock, same profit, same person, but $140 less in taxes just for waiting. And for higher earners, this gap becomes absolutely massive. But here's what gets really interesting. There are actually 3 different long-term rates most people don't know about. Pause for a second and guess. If you're a high earner making over $445,850 as a single filer, what's the maximum long-term capital gains rate you'd pay? Take a guess before I tell you the answer. It's 20%, still almost half the 37% short-term rate. Most people assume rich folks pay way more, but the long-term capital gains system is actually designed to reward patience regardless of income level. Here's where it gets sophisticated, and this is knowledge that separates smart money from everyone else. Long-term capital gains actually has 3 tiers: 0%, 15%, and 20%. If your total income including capital gains is under about $44,625 as a single filer, you pay 0% on long-term gains. 0. Free money for holding over a year. Between that and $492,300, you're at 15%. Only above that threshold do you hit the 20% rate. This creates some incredible planning opportunities that most financial advisors never even mention. For instance, if you're having a lower income year, maybe you're between jobs, or taking time off, that could be the perfect time to harvest some long-term gains tax-free. But the timing strategies go way deeper than most people realize. Smart investors use something called tax loss harvesting to their advantage, basically selling losing positions to offset winning ones. Let's say you made $3,000 on stock A but lost $1,200 on stock B. If you sell both, you only pay taxes on $1,800 of net gains instead of the full $3,000. But here's the trap. If you sell stock B for a loss and buy it back within 30 days, the IRS calls that a wash sale and disallows the loss. You have to wait 31 days or buy something similar but not identical. These aren't just theoretical strategies, this is how wealthy investors think every single day. And there's one more powerful technique that most people never consider. Here's the ultimate long-term play that multi-generational wealth builders use. If you hold stocks until you pass away, your heirs get what's called a stepped-up basis. All those unrealized capital gains? Gone for tax purposes. Your heirs inherit the stock at its current market value, not what you originally paid. Warren Buffett has used this strategy for decades. He's sitting on billions in unrealized gains that may never get taxed if he holds until death. It's controversial, it's powerful, and it's completely legal. This isn't advice for everyone, but understanding how the ultra-wealthy think about taxes changes how you see the whole game. Now let me show you exactly what you can do with this knowledge starting this week. Here's what you can do right now. First, check the purchase dates on any stocks you're thinking of selling. If you're close to the 1-year mark, consider waiting for long-term treatment. Second, if you have both winners and losers this year, plan your sales strategically to offset gains with losses. Third, if you're having a lower income year, that's prime time to harvest long-term gains in the 0% tax bracket. And fourth, start thinking in years, not months. The tax code rewards patience massively. Remember Sarah's $340 lesson every time you're tempted to sell early. How much could better tax timing save you on your next sale? Drop your calculation in the comments. I read them and love seeing your real numbers. The difference between smart tax planning and winging it isn't just a few dollars. It's potentially thousands every year that either stay in your portfolio compounding or disappear to taxes forever. Master these concepts, and you're already thinking like the investors who build real wealth. For more strategies that actually move the needle on your returns, check out nexusAIcalls.com.